Many people misinterpret the definition of a bridge loan. Here are the main points you need to know to completely understand the definition of a bridge loan and how it is applied in a real estate transaction. A bridge loan, also known as interim financing, is a short-term loan that helps a homeowner bridge the gap between selling their current property and buying a new one. It is used when a buyer hasn't yet sold their existing home but needs access to the equity from that home to complete the down payment or purchase of their new property. It allows them to buy first and sell later. Here's how it works. The lender advances funds based on the firm sale agreement of the existing home. This part is critical to remember. The property that you require the funds from needs to have a fully accepted offer on it. The loan is secured against the property being sold and sometimes also the one being purchased. The loan amount is usually up to the net equity that will be released once the sale completes. The bridge loan is typically repaid in full once the sale of the existing home closes and the sale proceeds become available. A bridge loan is commonly used when an applicant or a client purchases their next home before selling their current one, and the closing date of the new purchase precedes the closing date of the sale. And most importantly, a bridge loan is applied when the buyer needs to access the sale proceeds for either the down payment of the new purchase to fulfill the required down payment of the new mortgage, or if there is no mortgage transaction in the new purchase, they require the entire proceeds of the current home sale to purchase the property outright without a mortgage. For bridge loans where you are bridging the down payment for the new property purchase, terms are typically very short, anywhere from a few days to as long as 90 days. Interest rates are generally based on prime rate plus a premium. These days, about 4% premium is tacked on. Payments are typically based on interest-only calculation and they are charged daily. For example, on a $100,000 bridge loan for 10 days, your daily interest payment would be about $23. Multiply that by 10 days, you're looking at about $232. The provider of the bridge loan is typically the lender for the mortgage on the new property. When arranged this way, there are essentially no fees associated with the bridge loan, other than the interest-only payments, of course. For bridge loans where you are bridging the entire sales proceeds for the outright purchase of the new property, as with bridging for down payment, terms are typically very short, anywhere from a few days to potentially longer durations than with bridging for down payment applications. As with down payment bridging applications, interest rates are still mostly based on prime rate plus a premium, but in this arena, it could be a little higher. Let's say prime plus 4 to prime plus 6, and sometimes even higher. And in addition to the daily interest charges for the bridge loan itself, you will also very likely be charged a fee for the loan, anywhere from 1 to 2% of the loan amount. Okay, here's an example. Say you've sold your current home for $900,000, but closing is in 45 days. And you've just purchased a new home for $1.2 million with a $240,000 down payment that's required for the mortgage. Rather than waiting for the sale to close, a bridge loan allows your lender to advance $240,000 from your expected sale proceeds ahead of its completion date. So you can then fulfill the down payment requirements for the mortgage on the new purchase. Your daily cost of interest for the $240,000 bridge loan, based on, let's say, prime plus 4%, would be about $56 per day. So your total interest costs over the 45 days would equate to $2,500. The key takeaways here: a bridge loan provides temporary access to equity locked in your current property, ensuring your new purchase goes smoothly even if your sale hasn't closed yet. It's a short-term solution for timing mismatches, not long-term financing, but when structured properly, it can prevent deals from falling apart due to closing date misalignment. Thanks for tuning in. Remember, always use a mortgage broker, one application, one credit check, and access to multiple lenders. If you found this helpful, hit like and subscribe for more quick mortgage tips. I'm Marko Gelo, your British Columbia and Alberta mortgage broker.